you ever tried to fix something and you'll try, something's jammed or something, say a window sash, you know, it's jammed, and you applying pressure to it, and it won't move, you know, and you think, okay, you know, it'll move if I apply a bit more pressure, I can open it. And you keep pushing, and you keep pushing a little bit harder and a little bit harder and a little bit harder on the thing, and it just won't move, it won't move, and it won't move. And finally, when you apply a super amount of pressure to it, it bang snaps open like that, boom, unexpectedly. And it doesn't open because you just wanted to open it slowly. You just wanted to open it in a little crack like that. You kept applying more and more pressure, and it wouldn't move, wouldn't move. It's stuck. You know, and you keep pressure and pressure and push harder and harder, and all of a sudden, bang! It opens with a jar, and the glass shatters because the glass flies open and hits something and shatters, and the window all opens, and the air all blows in. Then the whole thing. I mean, it's just gone. The window's gone. There's not even a window there anymore. And you just meant to open it just to crack to let a little bit of air in. And suddenly you got a big breeze blowing in, no window there anymore, nothing to cover the window with. This is what's happening to the Federal Reserve. They are trying to get this whole thing to move. Trying to get interest rates to go up, trying to get everything to move. And they're applying more and more pressure. They can't help but apply more and more pressure. They have to. And they're caught in a trap. But what's going to happen is when this thing moves, it's going to move sharply and suddenly into a deflationary spike event that I've been predicting for a while now. It's going to move very sharply and very quickly when it finally moves. It won't move, it won't move, it won't budge. It's like the glass that's jammed. And then you apply more and more pressure, and all of a sudden when she moves, it's going to move all at once. And it's going to release all of this leverage, all of this tension that's been built up in the system. It's going to release it suddenly into a deflationary spike. And then it's going to require a great deal of effort on the other side for them to get it to slow down and get it to come to a stop. Let me read this article from Business. The Fed has been boosting U.S. investors for 9 years. Now that ends Wednesday being today. The Federal Reserve has straddled a careful line and fulfilled its twin goals of price stability and maximum employment. Well, first off, this maximum employment, that's a joke. They've created a whole bunch of part-time jobs, and they've lost a whole bunch of full-time jobs, and also they've changed the metric by which they count the unemployment. There's a lot of people now that they don't count anymore. They just don't count you. And so what they're doing is they're actually, it's a way of almost like cheating on the unemployment. So price stability, I don't buy that one either. So it says the 9-year and counting bull market in stocks could come to a screeching halt on Wednesday when the Federal Reserve delivers a highly anticipated climatic announcement that its 8-year experiment in easy money is over. Well, actually, this experiment in easy money, they've been tapering it back for quite a while now. And it's like applying pressure to open the window. They've put a lot of pressure on that window glass already. They've pushed really hard on it, and it hasn't budged. Like I say, when it finally slides, it's going to slide open all of a sudden, and it's going to smash the glass. That's going to be a market event when that happens. And this is what they're heading straight towards. But they're not going to stop. It says, many think the Fed's historic decision to unwind its $4.5 trillion balance sheet, which it used to keep interest rates artificially low and rescue the United States from a severe financial crisis or worse, is already baked into the markets. The stock market has essentially been expecting this for a while, said David Cass, a professor of finance at the University of Maryland. Well, to a certain degree, I believe that he is correct. They have somewhat, the stock market has somewhat priced this in. I do buy that to a certain degree, but I think that even though the stock market has somewhat priced this in, that it's still the effect, the leverage effect is still going to be applied to the market, and this leverage effect is like the pressure on the glass to snap the market later. It's like more pressure, you know what I mean? Even though it hasn't went anywhere, and it seems like you've done nothing, still the pressure's still there. It says it'll be a gradual unwind of the Fed balance sheet as it's been incorporated into current prices. Well, it doesn't matter how gradual it is. It's like a guy saying, okay, I can go out and drive my car drunk, he says. And the other guy says, well, how are you going to do that? He says, well, I'm going to gradually drink. You know? I'm going to gradually unwind the Fed's balance sheet, you know? It's like a guy saying, oh, I'm going to gradually get drunk, and that way I can drive my car. It doesn't work. This doesn't work. You can't gradually unwind the Fed's balance sheet, because at a certain point, you either unwind it or you don't. And at a certain point, it's like trying to sneak in through. They're trying to sneak this in without the markets noticing. At a certain point, this pressure is building up. It's going to snap, you know? Okay, so let's read on. It says, Cass said that so far the Federal Reserve has straddled a careful line and fulfilled its twin goals of price stability and maximum employment. Now the central bank wants to begin easing back to let the economy run on its own. First off, this economy has been on life support for a long time, and what they're basically doing is it's like a guy that's on life support. Been on life support for ages. They're unplugging him, and they're expecting him to come back to health and for full vigor, and to jump up out of the bed and run a marathon. No, when you unplug a guy that's been on life support, that's not what's going to happen. He's not going to jump up out of the bed and run a marathon. He's going to die, and that's what they're doing to the economy. They say now the central bank wants to begin easing back and let the economy run on its own. Fat chance. They're pulling back is going to make the economy die. It's not going to make it run on its own. It says, but nothing is certain. Just about everything Americans buy, sell, and do depends on the cost of money. And the Federal Reserve's actions on interest rates go a long way toward how much we pay to borrow, whether it is for a mortgage, a car, or next month's credit card bill. Investors are watching the Fed closely because its experiment in keeping interest rates low for so long has steered the nation's economy into uncharted territory. Oh, I guess it's into uncharted territory. I haven't taken a look yet this morning at the U.S. dollar index or at the bond prices, and so as soon as I'm done doing this article, I have checked the gold price, and this has smashed the gold price. Let me just take a quick look at the gold price again and see, because the last time I looked, the price of gold was smashing. It was smashing. Just a second until this page loads. Okay, we got a smash down on silver. It went down below $17. It looks like it's a rebounding. It looks like it stopped at 1693. It stopped at, and it looks like it's on its way back up. It's now getting ready to cross back over the $17 line again. But an absolute smash down on the price of silver and gold. Silver went down 28 cents. That's what it looks like as of right now. The market is going down. It's down 28 points. That's not a lot. Crude oil's up. Gold futures is 1307. So the S&P is down a little bit. The markets are really not down all that much. So the Fed has actually begun to shrink their 4.5 trillion balance sheet starting in October. And this is going to add a tremendous amount of pressure to an already pressurized, over-leveraged situation. We're going to have to wait and see exactly what the effects of this is, but I believe that the pressure is going to build up and the whole system is going to snap suddenly into this deflationary spike event. Because it's kind of like this. I'll explain it this way. I'll use one more analogy before I end this this particular episode. If you did have the guy laying on the bed and he's on life support, you know, and you go ahead and you pull the plug on everything, and you're expecting that he's going to get better, that he's going to jump off the bed and be able to run a marathon, because now you've done all this medicine to him, you've pumped him all full of medicine and everything else, and you think, hey, this is great, you know, and you've been keeping him alive with these medicines that you've been supplying him. An intravenous tube in his arm and oxygen on his face. So they pull the oxygen off of his face, they pull the intravenous off of his arm and everything else. And he's laying there, and the heart monitor's still hooked up, and you hear his heart going beep, 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 you know? And you can see his lungs going in and out, he's still breathing. And the doctor sits there and he says, look, it didn't do anything. I told you that he's fine. You know, we could pull all of this life support off of him, and he's fine. Look, he's fine. So they sit there in their chairs and they wait for about an hour or two, and nothing happens. Then all of a sudden, the beep, beep, beep on the monitor goes beep. You know. Then they get the effect, and the guy's chest quits breathing. He stops breathing suddenly. It's a sudden effect. It's an effect that was caused by what you did. Now, the Fed has been pulling the legs out from underneath this table, one leg to a time, and nothing's happened. It's like a game. I said before, I used another analogy to a game of Jenga. They've been pulling the little Jenga blocks out, and each time they pull a block out, nothing happens, so they think that they're God. The Fed thinks they're God. They think, oh, look, we can do anything. We can pull another block out. This is a big block that they're pulling right now. This is big. Them unwinding their balance sheets. Big. And they actually have the audacity to think that they're getting away with this stuff, and think they're getting away with unwinding their balance sheet. But what they're doing is they're putting this extra pressure into the system, and when the system snaps, it's going to snap suddenly and unexpectedly. And you know what they're going to do at the Fed? They're going to run around like chimpanzees with their hair on fire when this whole thing suddenly snaps into this deflationary event. And then they're going to come up with their solution, and it's going to be the same old solution that they came up with back in 2008. The same thing. They've already shown what they will do. They're going to pump liquidity, pump money into the system. But this time's different than 2008. When they go to pump the money into the system this time, there's been a huge, in the past 9 years, there's been a huge erosion of the U.S. dollar taking place. China has set themselves into position to take the dollar down. And so when they go pumping all that liquidity into the system this time, and China this time has all of that gold smelted down into 1 kilo bars. They've got it all set up for gold conversion into the yuan. This time when they pump that excess liquidity, and it'll be bigger than it was before in 2008, when they pump all that and they start the quantitative easing program, and I don't care what they call it, they'll come out with a new name this time for quantitative easing, but it'll be bigger and shinier than it ever was. It'll be more money involved. When they do that, it's over for the dollar. That's when America's going to go into a hyperinflation, if not a really bad inflation, if not a hyperinflation. I personally think it's going to end up in hyperinflation. And of course, it's only going to progress so far before finally they have to come in and do some sort of a reset, because the U.S. dollar is becoming worthless very rapidly. You want to talk about a mad rush into gold and silver and the cryptocurrencies and everything else that's not in dollar related. When the biggest economy in the world, when their currency actually loses value, you want to talk about a mad rush into commodities and into gold and silver and oil and cryptocurrencies and everything else that they can get their hands on that's going in the opposite direction from their blessed dollar. Blessed, the dollar is like sacrosanct. Anyway, if you're stuck in dollars when that time comes, then you're going to be out of luck, as the saying goes. You know what? Cow poop out of luck. Anyway, I'll catch you in the next episode. Thank you guys for listening. Push the like button, and we will catch you very soon. Bye.